Good morning, traders. Happy Monday morning. I have to tell you something. Monday mornings, I'm more tired than any morning of the week. I work like a maniac all weekend, partly because I just love this business. I do a lot of my coding for indicators and algorithms and all that stuff. So I'm usually dead meat on Monday morning, and this is certainly one of them. So if I sound tired, it's because I am. I literally have not gone to bed yet. So let's see what's on the docket today. Let me mention first, be sure to check out the video I did last night, the Sunday night video on how to set up your daily trading sandbox. Now, I'm probably going to recut the video because I noticed that some of the lines on the chart were hard to reach, because I use kind of a faded blue background, blueprint, it all goes together. But anyway, it is still legible, so spend some time on that, because it's very, very key that it's the KISS principle, keep it simple, stupid, right? You want to have your chart as readable and uncluttered as possible. And I want to start there, and then the next video I'll cut is how to move from level to level and read it. So anyway, good morning again, and let's take care of the securities regulators real quick. That's the risk disclosure. Be sure to take a picture of it. I have my watered down version, which I'm going to show you here in a second. And that goes something like this. And let me just read it. I know it's ridiculous, but I got to do it every time. These videos are intended to be educational and not advice or recommendations to purchase or sell securities. Duh. Futures, options, and other leverage instruments are highly risky and volatile. You could lose a lot of money if you don't know what you're doing. And by the way, you can still lose a lot of money even if you do know what you're doing. Just because something worked before doesn't necessarily mean it will work again, because the past does not predict the future. But how do you reconcile that with that? What was that old quote? He who doesn't study the past is doomed to repeat it. Whatever, right? But we got to say it. And sometimes it's true. Return on investment examples are complicated and could be calculated using different methods. Focus on learning process rather than trying to get rich overnight. When I talk about the fact that we've had triple-digit returns and things over the last 3 years, again, it is I guess a lot of money managers, just like the U.S. government, cook the books, so they use different types of calculations to quote investment performance. And technically, we're really not supposed to quote investment performance
Just a heads up here,
in something like this. We're not
is,
licensed advisors or anything like that. I mean, this is really
economic outlook.
Basically a blog, and we're trying to help you learn. We're sharing what we do in the hopes that you could be sort of an online apprentice. But it's certainly, we're not telling you what to buy or sell or when to buy and sell it. We're just sharing what we do so that you can learn. So neither Blueprint Quantitative nor any of our presenters, me, any of the people who present here, assume any liability for your investment decisions or losses. So I always joke, you're going to have to tell your husband or wife the truth if you lost money and not blame us. So anyway, by the way, I'm A.F. Thornton, and I'm the Chief Investment Officer and Chief Programmer and the author of the Navigator algorithms. And I've been trading the markets for over 35 years, actually even longer than that, because I started when I was a teenager. And this is the love of my life, as that does worry my wife from time to time. We joke about golf widows. She says she's a trading widow. So, but I do try to take some time with her every once in a while. And this is where I need your help. I'm hoping you'll gain something from this and learn something from it. And if you do, I only ask one thing: if you would hit the like button and or consider joining the channel and signing up for notifications. We are literally starting this channel brand new from scratch, and it's quite an endeavor. So we're starting at ground zero, trying to build a community. So I hope you'll hope you'll help us do that. So anyway, I think you will like the information presented. There's a lot of good information here, and don't hesitate to go over the website, blueprinttrading.com or blueprintquantitative.com. Always remember there's no E in blueprint the way we spell it. And you can always email me at info@blueprinttrading.com. And there's 2 T's there, all the little technicals. Anyway, don't, take a little snapshot and we'll get you where you need to go. So let's get out of there and jump right into it so that we can get done this morning. And what I want to do is start over here on the monthly chart, just again, so that you know where we're at, okay? And we are right now bouncing off the middle of the 2009 bull market channel. So we really haven't traveled that far in the scheme of things. And we are basically, there is an argument out there. If we're in a cyclical bear market, as opposed to secular, cyclical bear markets are completed in months. Secular bear markets last for years. Cyclicals tend to, drop about 20 to 25%. Seculars go about double that. So there is an argument that we've met the criteria for a secular, that this is all a secular bull market and it's going to keep going. And we could easily bounce from here. I mean, your NASDAQ's down 50%. I know a lot of stocks that we thought were the cat's meow during the COVID period that are down 80, 90%, as they should be, by the way. So, we have corrected a lot. So we want, even though my slight bias is still in favor of the secular bear, that we're only halfway to where we're probably going to end up right now. And I believe that we're just getting the benefit of the summer rally to bounce off the 20-week cycle. Have an awareness that things might be even better than that. So I don't think so, but, the market can surprise us. I mean, imagine what it will do. I mean, when you look at how much cash money managers have and hedge funds, if this thing took off, you could watch that FOMO kick in so fast, and we could end up at new highs. That would catch everyone off guard, or even up at the old high. So I keep telling people, always remember and be aware of a potential for a trading range, because it does happen. So anyway, that's where we are on the monthly chart. On the weekly chart, you don't learn a lot more, except you can get a pretty good picture of all the high volume nodes now. And this is the node that we're trying to get over here, right around 3,900. And it's a formidable obstacle. But a couple things keep me in the game here. One, if I overlay the 2008, 2009 bear market, you can see, and this is drawn to scale, that right here is where we took our first, meaningful bounce up before we rolled over again. And if you understand two-step corrections, you go A, B, C, which takes you right up here to the 89. And the 89-week moving average exponential is a very key average in a bear market. So you can go back and study it. That is definitely where we found resistance before. And then the 21-week line, which is the mean, is also sitting right here. So that would be a decent target, even if this is just another run up in this, secular bear market. And then, of course, we've got some, supply lines here. You've got one coming down here that we're at right now, too. We'll see that as we drill down to the smaller chart. And the one moving average from the weekly time frame that is in our window this week is the 5 period, which we'll look at here in a minute. On the daily chart, you've got the 50-day moving average up above us here. Again, you can get a little more granular and see that potential ABC correction. But as I've mentioned several times, actually I already have it drawn in here. So you can see that if the C wave is equal to the A wave, that's at about 40.50. And if we did a 1.618, it would take us up to these highs here. That probably isn't going to happen, but I do think you have to keep and have an awareness of it. Right now, this chart pattern is ambiguous, right? Because we're really sort of in a triangle. We're in a consolidation. We're up against that formidable resistance, you know, from say 3,900 to 3,925. So that's the hurdle we need to jump to make any further progress. And so just be aware, you know, if this, then that, if not, then what? So if we can continue to move higher here, obviously find some acceptance up in this range, then we could probably keep going. On the other hand, we may just continue to put in a triangle. So we might come down to, you know, you can draw a couple of lines here, you know, something like that and something like that. And we could play in this for the rest of the week. Because remember, on Wednesday, you've got the CPI, consumer inflation report. You've also got consumer confidence coming out. You've got the small business confidence coming out tomorrow. We've got industrial production at the end of the week, retail sales at the end of the week. So you've got a lot of stuff on tap. And already the consensus estimate for the top line CPI number is 8.8%. So, and then let me also mention we have monthly options expiration on Friday the 15th. So that has tended to draw, you know, no matter how many times I think there's some Vanna or, you know, tailwinds, options tailwinds going into that, it just always seems to roll over into it, and then we pick it up the following week. So there's definitely a lot to keep the market chopping around this week, and be aware of all of it. So let's drop down to our sandbox, and I did this in the Sunday night video, but I've got the lines brightened up a little bit more so you can see it. So this square right here is our weekly expected move windshield here. So it basically goes from 38.33 to 4,000. And within that, we've got the 50-day line from the upper time frame here, the 5-week line I mentioned from the upper time frame here, the 21-day line or mean sitting here, and the 5-day line sitting here. So look at the conglomeration of moving averages sitting here, also at roughly that same node, you know, just below 3,900. And unfortunately, we've dropped below these levels overnight because of the globe. In fact, we made gap open, so keep in mind gap rules will likely be applicable this morning, but we got down as low as 39.62 or so overnight. So as usual, our cousins over in Europe are stealing our thunder again. So, you know, we're right in this level here. We can go either way. I still slightly favor some more upside because of the 20-week cycle bottoming over here. But, you know, I don't really know, and nobody really knows. So obviously acceptance up in here above the supply line, moving on towards 39.50. And remember, the market always conquers 50-point increments. That's what it's always doing. So we've got the roundy at 3,900 here. We've got 39.50 up here. And that brings me to the daily expected move, which is the smaller square in here. And that expected move is basically 38.50 to 39.50. So we have a 100-point range for today, potentially. So obviously the roundies and half roundies are going to be pretty relevant today. So you've got these moving averages sitting here. You've got that high volume node sitting here just above 3,900. Obviously always mark the open. We've still got this gap down here that might fill at 3,800. We've got some virgin points of control in here. So there's a lot in here that can provide support. And that takes me over to the book. Let's take a quick peek at where the orders are this morning. And what you'll see here is we definitely have a lot of resting liquidity under the market here. And I guess that's basically where the majority of the orders are, between about 38.50 and 38.65. Now, traders can pull those orders, but there's definitely liquidity down here, and that's going to tend to draw the market down like a magnet. There's a little bit of liquidity at 38.80. And what I'll have you notice is over here on my left-hand side, I've marked all the key levels that will be moving to and from throughout the day. And I've also marked the low and the upper time frame low and high volume nodes here. This is a little bit repetitive over here. So right now we're sitting just above yesterday's low, and we have dipped below it overnight and come back up into range. So I would watch that level. And what I do is, I'm always cognizant of where the point of control is for the day. And the first thing I want to know is if we're trending or if we're balancing. I mean, that's a pretty key issue. And then I just try to get aligned with it. And the way I get aligned with it is I find an area where I can get a position on and ride it to one of these key levels, which is where all the amateurs put their stops. And then I let the stops go off a couple of times, and I try to see if the institutions are picking up those trades or if it's just the amateurs continuing, because generally speaking, institutions don't use stops. They just go in or go out, and they're not all that price sensitive when they make a decision. So in a lot of ways, we're just competing against the other people that are like us but aren't, as experienced. So whether or not institutions are picking up these orders, I can tell that from the icebergs here. And then I can pretty much tell, like you can see this area of exhaustion above the point of control here. You do see stops going off, but like 41 of them went off here, and then you get over here and only 5 are going off. And that's usually a sign of exhaustion. And I can sort of measure that down here. Like here's a good example of stops going off, but the blue line tells me that the institutions were buying, and that's right here. So the institutions are stepping in down at these levels here, which is good and probably will provide some support to the market. And by institutions, I mean market makers and dealers and large people that are doing large orders, not to be confused with algorithms. Sometimes they're algorithms, but for the most part, that's the smart money, and it usually pays to align with the smart money. So on the upside, we've got the hourly 21 providing some resistance here. Here's the 5-day line right there. Here's the 21-day line, also providing some resistance. And then that's the middle of June. That's a June, I call it the pivot. And then we've got yesterday's low. So that's what we're initially dealing with this morning. And what I'm going to watch over here is I'm going to watch the auction and just see if prices are, only one contract went off up here. So obviously, as this tapers off here in volume, you know that you're getting close to peak. Same here. So this is a pretty good balancing profile. And then you can follow it in the micro time frame over here.
BlackRock say they
so anyway, let me just see if there's anything else. I guess a couple of things out. When I talk about other markets and things, realize that it's interesting, but I don't need any of that. All I care about is what's in my sandbox and what the price action is doing here on the S&P 500. It may be influenced by other things, but why do I care? I can read this. And, it's kind of like reading music. Once you learn how to read it, I don't really care or need to know what's going on in other places, but I'll mention it for you. Obviously, the overnight market is weak. And as usual, the Europeans stole all our gains and thunder, whether you want to be long or short. Gap rules will apply. Go over the website, Blueprint Quantitative or blueprinttrading.com, and go to the glossary, and it'll define those rules. The U.S. dollar is just continuing to climb. I think more than anything, it's a flight to quality. And even though we may have strong opinions about the quality of the U.S. and the dollar right now, look at it as a lesser of evils. So it's better than anything else right now. It doesn't make it good, but there is a lot of money going into it. And that, again, has repercussions. That's going to put pressure on the stock market, certainly pressure on corporate earnings. There's a lot of things that can be affected by that. So just, keep an eye on it, have an awareness. The developing, I'm calling it the midterm COVID strain, because I've been waiting to see what the Democrats are going to come out with to try to keep everybody home and get those, lock boxes out again so they can do their 2,000 mule cheating strategy. So, and maybe the Republicans do it too, I don't know. But in any event, there is a COVID strain that's supposedly more contagious and more virulent than the last one. Well, of course there is, right? I mean, the election's coming up. We got to figure out some way to, come up with martial law or whatever it's going to take so that the current people in power don't lose their position. So always keep that in mind. I already talked about the ambiguous chart pattern. The Twitter saga, I get the biggest kick out of this because Elon Musk is now saying he won't buy Twitter. And he did a meme. And of course, I'm a lawyer, so I totally get this. The reason that he won't buy it is because they refuse to give him the data that lets him figure out how many fake accounts there are. But now that Twitter is considering suing him to complete the deal, first thing the court's going to do is make him turn it over. It's comical. The whole thing is just comical. Keep in mind that earnings are now going to start taking center stage. I mean, not that rates are going away or problems with rates, but we'll start next week with the financials, the brokers and banks. As for today, Fed Governor Williams speaks around 2 p.m. Eastern time. You might want to be out of the market for that because these speeches have been moving the markets. We do have some T-bill auctions today. We'll see how that goes. They've not been going as well lately as they had been. I already talked about Wednesday as CPI, the beige book. And then, of course, we get the producer price index and employment claims on Thursday and retail sales and industrial production Friday. So there'll be a lot going on this week, as always, and we'll keep our eye on those things. But for the most part, we're going to focus on the price action. We know what to look for. We know where we want confirmation and acceptance of price either above or below this current consolidation triangle to really have an idea of our next direction. Your job in the first few minutes, we'll have gap and gap rules this morning, which gives you a potential gap trade if you look at those rules. But otherwise, you've got to let the market settle in and either continue to balance or take a direction before you know how to deal with it from a day trading perspective. As I've said many times, I exclusively trade the S&P 500 index, whether it's options or futures, because I decided a long time ago I wanted to make money, not entertain myself. And so I thought if I learned one thing really, really well, that would stand me in good stead. So that's what I've done. And you can apply any of these principles to any financial instrument, everything I discuss. And in fact, if you already know what the S&P is doing, that gives you kind of a heads up on individual stocks, because the index is what drives at least 60 to 70% of most returns on stocks. So the index is going up, chances are your position's going up. So keep that in mind as well. Let me sign off there for the day then. I'll be back this afternoon with some follow-up commentary. Good luck today. Mondays can be interesting. Always remember that people come back from the weekend and tend to spend the first hour or two just readjusting their portfolios based on what they learned over the weekend. So sometimes some of the indicators and strategies that you practice don't always work on Monday mornings. Mondays and Fridays can be interesting to trade. Fridays, you've got options expiration, people going into the meeting, going into the weekend. So, I'm always a little reticent on Mondays and Fridays anyway, and a lot more careful. But anyway, have a great trading day. I'll be back this afternoon. And just do your best, get your sandbox up there, follow the rules, and you should have a great day. Thank you very much. Again, if you get something from these broadcasts and you're learning, please consider hitting the thumbs up button and the like button. I guess they're the same thing. Join the channel, join our community, go to the website, see what we have over there. There's a lot of good information that's free. And we also have some subscriptions if you really want to get into the nitty-gritty detail. So